Good afternoon, everyone, and welcome to the 25th Annual Market Outlook, hosted by Bender Commercial Real Estate Services. I'm Michael Bender, and he's Reggie Kuipers. We're two of the 5 partners here at Bender Commercial, and we're very pleased that you're here. From the very first year, we've strived to provide information to you, the business community. That information, we hope, is timely, it's accurate, and most importantly, it's trusted. And with that information, we try to provide prognostication and predictions, if you will, and that you can use for your business decisions. So we're humbled that you're all here because it says to us that you trust our information. So thank you for your presence and being here. I can remember a number of the market outlooks. Since this is our 25th, it's also our 25th anniversary of the founding of our company. But I can remember, some of the more anniversary ones, like the 10th anniversary. That was certainly a milestone. The 20th was another big milestone. I'll certainly remember this one as well. But I very vividly remember the very first milestone, the first market outlook, and that was back in 1997, the end of the year. I invited 5 people to lunch at Minnehaha Country Club. I prepared a 1-page statement of some statistics, and I presented it to them and basically told them what I thought was going to take place the following year. It was easy for me to do that with 1 page. Now, what you're going to see today is totally different, as you know. There's a lot of people, in addition to the presenters who get all the attention, there's a lot of people on our team that worked hard to put this together. And I want to take a moment just to thank everybody at Bender Commercial and Bender Midwest Properties for their effort and for putting this all together. So if you'll join me in just thanking them. Well, many of you know that in the last 12 months, there's been a leadership change as well as an ownership change in Bender Commercial. And it was time for me to take a step back. I felt like these guys, I just was holding them back, basically. And so it was definitely time for me to take a step back. Now, that doesn't mean that I expect everyone here in the audience for about the next 10 years to hire me instead of any of them, because I'm still going to be busy working for you and doing real estate. So, but it was time. It was definitely time to take a step back. And with that, it's my opportunity and pleasure to really turn the reins over and introduce Reggie as the president. He's already been named that for a while, but we're going to hear Reggie open up the market outlook and give his thoughts and ideas on where we're heading as our economy. And so with that, Reggie, take it away.
All right. Well, thank you, Michael, and welcome. It's really good to be back with you here. We did this as a remote event last year, and so it's good to see familiar faces and friends and colleagues and partners, and we are excited to have a happy hour with you after this. As he said, we've got a team. Summer Hoffman's been with us for a couple of decades, doing a lot of the heavy lifting that you're going to see here today, and so we just want to give her a special shout out and the rest of our team as well. Additionally, I want to say thank you to the City of Sioux Falls, Minnehaha, and Lincoln County, the equalization offices. They provide a lot of the intel, sometimes before they're ready to hand it off to us, but allow us the opportunity to present it in this form today. So a special thank you to the city and the county. And as Michael said, this is a special day for us. It's 25-year anniversary of both the Market Outlook and Bender Commercial Real Estate. So I'd be remiss if I did not, have a special thank you to the core, the foundation of our company, Michael Bender, Andy Anderson, and Doug Brockhouse. So a huge thank you to you guys. All right, let's get started. When we started looking at all that information and diving into it, it's no surprise to anybody in here. Sioux Falls had a wonderful year. it was a banner year. And so I'm going to start the presentation not by focusing so much on all the things and the headlines you've already heard, but we're going to look at a macro view, and we're going to start from a national view and what's changed since 2020. There's been a massive demographic shift from blue states to red states. That's a big chunk of it, but it's also where and why we choose to live where we live. In the middle of the pandemic, a new term was coined, the exurb, where people were exiting dense urban areas and moving to the suburbs, moving to the acreages, moving to their secondary homes. And that's going to be an interesting trend to watch to see if we can revert back to that urban living. A couple of trends that don't have a tremendous impact on real estate, but we did want to highlight: higher education. Certainly probably in need of some disruption. It received it in the form of a pandemic, and that's going to continue to evolve over the next decade, and there are going to be some winners and some losers. We have a swift drug development and approval program. What used to take the FDA years now can be done in months, and that's a win for all of us. Big government is back. The Keynesian model of in times of economic stress, you combine low interest rates with low taxes and high government spending. And that model seemed to work pretty well over the last 2 years, maybe a little too well. You're going to hear a lot about inflation in the next hour. And when you combine all those inflationary factors with a bottleneck supply chain that Rob Fagnan is going to highlight here in a few minutes, it was a perfect storm for some higher pricing. Another trend we wanted to talk about and touch on was the Great Resignation, another term coined in the middle of the pandemic. Prior to the pandemic, 152 million Americans were working. January 2020, at the trough, at the bottom, in about a month's time, 22 million Americans lost their job. That was a tough month. It seems like a long time ago, but it was only 2 years ago. America's been resilient. We've averaged over the last 15 months about 500,000 net new jobs every month, and we're slowly coming back out of that. A recent Goldman Sachs report said there's still a demand for about 4.5 million new jobs. I don't know where we're going to find that equilibrium, and we're still trying to get people back into the workforce. What's causing that delay? There's some COVID factors, COVID concerns. There's some government incentives to stay home. Vaccine mandates certainly didn't help. Childcare costs. Anecdotally, I can tell you I've got 2 kids in daycare. My childcare costs have gone up 25% year over year. If you're a mom or a dad sitting at home trying to decide if you're going to jump back into the workforce, you have to weigh that in. And you have to find a job that's going to offset those costs. But the good news is we are coming back to work. The labor participation rate has spiked up, especially in women in the fourth quarter and in January of this year. So we're coming back, and really we think this is just the great American sabbatical. Well, we touched on inflation. Let's look at it. The red bar here is your PPI, Producer's Price Index, for non-residential construction, so your commercial construction costs. 13% year over year. Wow, it's getting really expensive to build a commercial building. Take, in contrast, the CPI, 7.5% year over year. That's already a huge number, but those two have never been further apart. So what's going to happen? Let's take a deeper look at inflation. This is a historic view, all the way back to the 1960s. As you can see, over the last 4 decades, the Fed's done a pretty good job of moderating inflation. If you look at December of 21, 7.5%. You got to go all the way back to 1982 to see that same number. Well, the Fed is going to react to this by raising interest rates. They're going to meet on March 15th this year. We think that they're probably going to hit the easy button with all the geopolitical unrest, energy pricing, a lot of world things going on. 25 basis point increase. They've talked about 50 in the past, but we think that it'll be 25 for this go around. But borrowing is going to get more expensive this year. What's it going to do to commercial real estate? I'll save that for my predictions. Let's take a look at a local example of inflation and appreciation. This is the Shriver Square building. Now, we could have put several buildings up on this slide. There were several buildings that traded hands twice over the last 10 years, but this was probably the most high profile. In July of 2014, this building was sold for $3.6 million. That buyer pulled less than $100,000 of building permits over the next 7 years. and sold it earlier this year for $6.7 million, almost a 2x return. That's a good real estate deal. But because of the lack of building permits, we think that there's still some runway with this building, and we look for those improvements to happen here in the near future. All right, let's go to the next. What's causing this? What's causing everybody to pay up for real estate? Guys, this is my home run slide. Bank deposits. Prior to COVID, all U.S. banks, $13.3 trillion in bank deposits. Right now, over $18 trillion. You want to know why people are paying for real estate? Because they can. In contrast, state of South Dakota, it's the same trend line. We took the top 10 community banks in Sioux Falls. They're at 44%. So we think the best hedge against inflation is to take some of those dollars and to invest them into commercial real estate. All right, we're going to transition now and look at some of the local factors here, some of the micro stuff that's going on in Sioux Falls. We're going to start with employment growth. Red bar at the top, that's Sioux Falls. Historically, it's outpaced both the state and the nation. This year, a little bit of an anomaly. All three of them landed at 2.4%. We would look for Sioux Falls to continue to outpace as we go into the future. Why do we think that's going to happen? Let's look at population growth. We're going to take a stroll down memory lane as we're here at a 25-year anniversary. 1997, Sioux Falls was 110,000 residents. Currently, we're just eclipsed 200,000. We think that we're probably going to be over 300,000, 310,000 in the next 25 years. Now, that's not really that big of a slide. But the hidden factor in this is Braden's going to present next on the land market. And he's going to tell you about Highway 100, Veterans Parkway, and the impact that that's going to have not only on land transactions, but what it's going to do to our community. As Brandon pushes west, Harrisburg north, and T north and east, that's truly going to make us a metro area. And we think that the metro area in 25 years is going to be closer to 400,000 people. That's going to be a lot of fun to take part in and help that growth. All right, let's go to the next. So let's look at building permits. PTH, Mayor Paul, my team wanted me to superimpose your face over this. and I won. We held off. I said I can't have any PTH deepfakes, Dr. Evil deepfakes this close to the election. So it's no surprise to anybody in here. It's over $1 billion of transactions and building permits pulled last year. We're not going to spend a lot of time on that. I am going to spend a little time on the red bar. That's $730 million of commercial and multifamily building permits that were pulled last year. The next slide is going to focus on the new commercial construction of that. That's about $465 million of that 730. Take a look at that purple bar. Multifamily. Almost outpaced 2-to-1 the other four asset classes combined. It's a lot of apartment building in Sioux Falls last year. And we think that's actually going to expand next year. Two other things to look at on this slide. That orange bar, industrial. Historically, last year you see the Amazon spike, and then it came back down to reality. That's probably going to go back up this year with the CJ Foods deal. And another thing, the red bar, retail. Retail gets all the headlines. Front page of the newspaper, everybody wants to talk about retail. It's consistently one of the lowest contributors to the new construction categories here. And I only bring that up because there's a lot of other deals that take place in our community that don't get the same buzz. Let's take another look at this correlation between new construction and addition remodel. In an expanding economy, the new construction will outpace addition and remodel. As you can see here, that blue bar, almost 2-to-1 over addition remodel. And we think that's going to continue to separate as we move through 2022. Another thing to note on this slide, historically we've had these massive outliers, an Amazon building, schools getting built at the same time, hospitals, event centers. Not this year. We had 18 permits pulled over $10 million, 9 of those over $20 million. That's a really healthy sign. We're spreading it out. So let's take a look at how we did in comparison to the regional comparison, our sister cities. No surprise, again, you see that $1.1 billion mark. We took it on a per resident basis, on a per capita, $5,700 spent for every resident in Sioux Falls last year. It's a really good year. But you take that in correlation to the other sister cities, we're actually towards the bottom of that line. We talked about that demographic shift earlier, where people are moving to the upper Midwest, and it feels good to be anywhere in the upper Midwest right now. Some predictions for 2022. 2022 is the year of the son-in-law, slightly below expectation. You can ask my father-in-law, he's in the audience. A little less of the same. It's going to be a great year. We're going to have a lot of success this year. You're going to see residential multifamily, both in Sioux Falls and in the country, have an all-time record. The industrial market, absolutely on fire. Hardly any industrial vacancy across the country. Interest rates, what's that going to do to real estate transactions? For owner-occupied real estate, probably not going to have any impact, very, very little. What we do think will happen is that it'll stop the compression of cap rates. So 2022 is probably the peak year. If you're a seller and you haven't sold, this is probably the year to think about it if you are contemplating it. Well, how do we get to 400,000 people without adding new people? So we're going to have some population growth this year. We predict that in Sioux Falls we'll probably not quite hit that 7,000 mark that we hit last year, but it'll be between 5,000 and 6,000, and the metro will be between 8,000 and 9,000. That concludes my presentation. I'd now like to bring up Braden Isis to present on the land market. Thank you.
Well, thank you, Reggie. As Reggie mentioned, my name is Braden Isis, and I'll be presenting on the land market. As we always have, we divide the land presentation into two categories, the unimproved land and the improved land. We'll start with the unimproved land, and boy, do we have a lot to talk about. That's not a typo. 28 land transactions last year in 2021. If you're wondering, that's equivalent to the previous 4 years combined, all happening just last year. Where did these take place? In this area, you see the red dots representing the past transactions going back to 2012, with that horseshoe shape around Sioux Falls and a higher concentration in that kind of southeast quadrant. Let's overlay last year's transaction. Where did they take place? Full circle, all the way around Sioux Falls. What's the trend? Sioux Falls Metro itself. Land buyers and developers are bullish on the Sioux Falls Metro. Let's take a look at some pricing. Now, in past years, we've been able to highlight each transaction's pricing. With so many transactions, we broke this down into three categories. First, long-term land banking. These would be sites that maybe not developable today, but developers are getting control of them for future development. Think between Sioux Falls and Harrisburg. Price point, $16,000 to $26,000 per acre. Second, mostly residential, $25,000 to $50,000 per acre. Price point, $30,000 to $25,000 that we're seeing in Harrisburg and in T, where into the Sioux Falls we're seeing closer to the $40,000 to $50,000 range. And then lastly, mostly commercial. These would be kind of retail and industrial developments, $50,000 to $75,000. Let's take a look at some more data. Now, last year, we put this graph together to show the number of acres that were sold each year. Now, the year of 2020, the year of the pandemic, it was really tough to forecast the demand, and we really saw that with only about 200 acres purchased in 2020. Now, a year ago today, we knew we were coming out of the pandemic strong, and I boldly predicted that we'd get back on track and maybe come up to about 500. Let's see how that bold prediction panned out. Not double, we 11x'd the previous year. That graph shows just under 2,300 acres that were purchased in our Sioux Falls Metro. Just to put that into perspective, the city of T has about 2,200 acres annexed into the city limits. So land buyers and developers went out, purchased the city of T last year. That's a big year. Why did that happen? Well, Reggie touched on it in his presentation, population growth. Coming out of the pandemic, our population accelerated, and what that did is put demand in housing, and developers are feeling that demand in their own existing developments with the number of homes and lots they're being sold. And because of that, they're going out buying land and trying to capture some of that demand. What's that do to our supply and demand in our market? Well, this graph shows the relationship of supply and demand with residential lots. You can see coming out of the 2008 recession, that wide gap in between the amount of lots available and the demand. That is narrowed all the way to 2020 with the smallest gap. What that indicates is there's additional supply needed in our market. And plus, you forecast the amount of demand that we're seeing, I think actually this much supply is probably going to be healthy for our market. That concludes my presentation on unimproved. Let's move on to improved. As defined, we take the large tracts of land, developers do the dirt work, add infrastructure, utilities, curb and gutter. They break those large tracts of land down to smaller lots and sell them on a per square foot basis. Let's look at the graph. As you can see, we had 90 transactions last year, a historic high, with a historic sales volume of just under $90 million. Let's break these down into asset classes. As you can see, we had strong years in all assets. Office remained steady. Multifamily, huge year, 18 transactions last year in our market. Industrial, just off the pace of a historic year last year. Look at that demand we're seeing in industrial the past 2 years. More to come on that. And then lastly, retail, 30 transactions, second best year that we've seen. Let's take a look at some pricing. Now there's a lot of data right here, but there's really two things I want to touch on. That first one being industrial at $325 a square foot. That really doesn't represent what we're seeing today. Towards the end of last year, I pointed out that demand that we've seen in industrial land. What that has done is really put a stretch on our supply of industrial ground. And that has really pushed up the pricing. Towards the end of this year and the beginning of this year, we started seeing pricing $400 to $450 a square foot. And just to add another note, the Development Foundation, which usually sets the bar for industrial ground, they're now listing their ground at $375 a square foot. Moving on to multifamily, $430 a square foot. That's a bump from what we've previously seen. And I think that's a strong reaction to the demand in housing in our communities. Let's take a look at some trends and takeaways. As Reggie mentioned, Veterans Parkway, that's the connector of our communities. Harrisburg, Sioux Falls, and Brandon. That's going to be the artery that bring us all together. And because of that, that's a huge attraction for all asset classes. Out of those 90 transactions that we saw this past year, 40% of them happened along that corridor. And I don't see that slowing down anytime soon, especially with the construction starting on South Veterans Parkway and that traffic going to start. Moving on, industrial land supply. I've touched on it already. We need more supply of industrial lots. And the Development Foundation is reacting to that. They're adding infrastructure in Park 8, expanding their park. And I wouldn't be surprised if we hear an announcement this next year with an additional park or maybe another expansion of their existing ones. And then lastly, just want to bring this up, touch on it as it is something that's going to affect development of land. The city of Sioux Falls updated their regulations this past year on how they look at the development of flood ground with the future FEMA maps. Something to be aware of as we move into the future. Let's take a look at my predictions. I have bulk land going down, only comparing it to the monster year we just had. I still think we're going to have a strong year. We might not buy the city of T, maybe the city of Hartford is more manageable. Industrial, I have it up, but at an angle. Again, that supply might hold us back a little bit from having a historic year. Retail is going to continue to be strong. Office, I have it pointed down. And then lastly, multifamily is going to be way up. And I see, and Nick will touch on more why we see that happening. That concludes my presentation. With that, I'd like to bring up Alex Soundy to discuss the office market. Thank you.
Thanks, Braden. As Braden said, my name is Alex Soundy, and I'll be talking about the office market today. Start with a quick outline of what we'll be going over. First, we'll look at the national market as a whole and some predictions and trends we're seeing. Then, we'll dive into the Sioux Falls market before breaking out the downtown in suburban submarkets before getting into some predictions for the office market going into 2022. Let's get into it. So I'm sure many of you in the audience can relate to one, if not all of these pictures at one point in time in 2021 or 2020. Originally, I planned to wear some Nike breakaway sweats with some shorts underneath and in dramatic fashion, break away into my comfy on bottom and business on top attire to really give an example of what a lot of you probably wore over the last 2 years if you're working from home. Ultimately, decided against that, did not want to risk a wardrobe malfunction on stage. But on a serious note, COVID has completely shifted the way we view office space. Did you know that 1 in 7 job listings on LinkedIn offers some sort of remote working opportunity? That number before the pandemic, 1 in 67. Think about that. That directly trickles down to the demand for office space. If you're an employer and you're trying to entice your employees to come to the office, you need to offer a quality workspace or some type of incentives that make them want to come to your office as opposed to their home office or, quite frankly, their living room. So what's happening to some of that older, worn-out office product? Picture on the screen is Allstate's corporate campus in Northbrook, Illinois. Now, this is about 2 million square feet of office product that was brought to the market in 1967. Allstate recently announced they're under contract for $232 million to sell this to an industrial developer who plans to repurpose this to some industrial space. Another example, this 556,000 square foot office complex in Alexandria, Virginia. Now, this was sold last year to a multifamily developer who plans to repurpose this into 435 units of multifamily. Let's take a look at a local example. Just this past January, Graco purchased one of Wells Fargo's call centers on North 4th Avenue. When this product was brought into our market in 1986, it was originally brought in as a manufacturing facility. When Wells Fargo took occupancy in 1999, they repurposed it to fit their need for a call center at the time. And with Graco's purchase this past January for just under $8.3 million, Graco plans to repurpose this property back to manufacturing. I think we're going to continue to see older office product get repurposed for other uses in the years to come. The graph you're looking at here shows the share of office space that is older than 30 years old by city. As you can see, New York, San Francisco, and Los Angeles all have over 75% of their office product that is 30 years or older. Now, I'm not saying that 75% of the office product in these markets is going to be repurposed from office. But what I am saying is that these landlords are going to need to reinvest in these buildings if they haven't already, or sell to investors, developers, or business owners that will. For comparison purposes, Sioux Falls has 39% of its office product that's 30 years or older. Now, for those employers that have committed to going back to the office, we're seeing some pretty positive trends. It's a pretty busy slide up on the screen, but I want you to focus on the 2 columns that are highlighted. The first one is Q3 of 2020. A couple months into the pandemic, as you can see, there was only 23% of tenants that were willing to commit to long-term 10-year or more leases, whereas 46% of tenants were only willing to commit to lease term of up to 3 years. Now fast forward to Q4 of 2021, and that is nearly flipped. You have 45% of tenants that are willing to commit to long-term leases of 10 years or more, and only 22% that are only willing to commit to up to 3 years. This is a really positive trend for the office market. Now, let's look at Sioux Falls. Sioux Falls is about 8.5 million square feet of tenant-occupied office space, which is just under 53% of the 16 million square feet of office space we have in our market. Vacancy rate overall classes held pretty steady at about 9.6% last year, down slightly from 9.9% the year prior, all while absorbing 195,000 square feet of new space into our market. Main highlight on this slide is the 3.3% Class A vacancy rate. If you own a Class A office building anywhere in Sioux Falls, it has to feel really good, especially as asking lease rates for Class A property are continuing to increase with the price of new construction. Let's take a look at some office sales last year. Last year we had 50 transactions for over $90 million. That 50 transactions is a record number for Sioux Falls. Why did this happen? low interest rates and business owners and investors being flush with cash and investing in the Sioux Falls market. Think about that for a second. There was 50 business owners or investors that, in the middle of a pandemic, invested in the office market in Sioux Falls. That is awesome, and that's a great trend going forward. Let's look at a couple of those transactions. You see the old First Premier Bank building on 14th in Minnesota. This was purchased by First International Bank and Trust in October of this past year for $2.65 million. The former Core Orthopedics building on East 26th Street was purchased in November of this past year for $1.95 million. This was purchased by an owner-occupant who plans to occupy a portion of the building and lease out the remainder for some additional income. Now, this is something a trend we've seen to pick up in the last year to 2 years, with business owners capitalizing on low interest rates and purchasing buildings bigger than what they need and utilizing the additional space for some additional income. Now, let's take a look at our submarkets, starting with downtown. Now, we've been saying this for a few years, but our downtown is no longer just a downtown. Our central business district consists of 3 submarkets. We have downtown, highlighted in red, uptown, highlighted in the purple, and our East Bank, which is highlighted in blue. The expansion of our downtown market is a direct result of businesses' desire to be downtown. The Steel District and Sharapa 2 are both a direct result of that demand. I'll touch on both of those projects a little later in this presentation. So let's look at the numbers. We have about 2.36 million tenant-occupied space in our downtown market. Overall vacancy rate is very healthy across all classes at 5.8%. I'll dive into the vacancy rates a little more in the next slide. We absorbed about 61,000 square feet of new office space into the downtown market last year. One thing I'd like to highlight and that we'll keep our eyes on over the next 2 years is that asking lease rate for Class A office space. With the additions of Sharapa 2 and the Steel District, those are going to increase the Class A asking lease rate. With asking rates on both of those projects north of $25 a square foot, expect that lease rate to rise. And we're actually going to see a reshift of what Class A office space is downtown. So let's look at vacancy rates a little more. So as you can see, for 6 consecutive years, Class A office space has had a vacancy rate of below 5%. And last year, Class B and C office space took a healthy correction from being a little above 11% in 2020 to about 6.6% in 2021. Now, we've been saying for a couple years now that Sioux Falls downtown could use a multi-story, multi-tenant office building. The demand is there. Well, why not 2 of them? As you can see on the screen, you have the Steel District on the left. This is a mixed-use retail, office, hospitality, and residential development taking place in Uptown. This was announced this past year, and this is going to bring about 150,000 square feet of Class A office space to the downtown market. Notable tenant announcement there is C&B Operations. And on the right, you will see Sharapa 2. This was also announced this past year, another mixed-use retail, office, and residential development being brought to East Bank. Now, this is an expansion of Sharapa Place, which was originally brought into our market in the mid-2000s, which was the true pioneer for riverfront development downtown. Now, this is going to bring about 175,000 square feet of Class A office space to our downtown market as well. Some notable announcements there: Eide Bailey, ISG, Bancorp, MarketBeat. Guys, this is really cool for our downtown. To put this in perspective, when the Event Center was brought to our market in 2014, that was a $115 million project. And that was a huge deal. That was a big number. Now, when these 2 projects are complete in the next couple years, that's going to be a $425 million north of that investment in our downtown market. Think about that. That is great news for our downtown and great news for Sioux Falls. This is going to completely reshape how people view Sioux Falls. From all of our competing markets around us are going to look at Sioux Falls differently. So very exciting news there. One thing I'd also like to highlight too is as we move some of these tenants from previous downtown spaces into these new projects, that's going to leave some large vacancies. But I do believe that demand is there to absorb that. But we should anticipate to see vacancy rates in downtown continue to increase over the next couple years as that absorption takes place. But I do expect us to remain relatively healthy and stay in high single-digit vacancies, as, like I said, the demand is there. Let's take a look at our suburban market. There's about 6.15 million square feet of tenant-occupied office space in our suburban market. I'll highlight vacancy rates a little more in the next slide. We absorbed 134,000 square feet of new office space in the suburban market last year. Once again, keep an eye on Class A office space asking lease rates, as they will continue to increase with the price of new construction continuing to increase over the next couple of years. So a little deeper look at the vacancy rates here. Our Class A vacancy rates have taken a healthy turn downward in the last 3 years, settling in at just about 3% last year. Same thing goes for our suburban market as we were saying about our downtown market. There is a demand for some new multi-story, multi-tenant office space there. So I expect to see 1 or 2 announcements of those in 2022. Area to keep your eye on, South Minnesota Avenue. Now for Class B and C vacancy rates, those have remained pretty high the past couple of years and creeped up to just under 15% last year. If you're a landlord and you own Class B, C, second or third generation office space, and you're dealing with high vacancy, you might want to reconsider it or consider investing in that space to attract tenants, or selling to a business owner, investor that will, or a developer that might repurpose that space. Now, before we get to some predictions, I'd quickly like to highlight shadow vacancy. Now, this picture was taken during business hours on a Tuesday. We're still continuing to see parking lots of these large corporate offices appear somewhat vacant, as the majority of their employees are still working from home. We believe these business owners that are dealing with COVID are on a 3-year timetable for how they're going to handle COVID in their office space moving forward. We believe they're in the second half of that timetable, and decisions will be made this next year for how they are going to handle that office space going forward. That's something we're going to keep our eyes on. Now, a quick snapshot of how Sioux Falls compares to the national market. As you can see, Sioux Falls has about a 6% lower vacancy rate than the top 50 markets nationally. This is super healthy, and this is really good for Sioux Falls. This shows the strength of our market. I expect Sioux Falls to continue to outpace the national average and outpace that national market in the years to come. Now, some trends and predictions for the office market moving forward into 2022. I think we're going to have continued interest downtown. Expect 1 or 2 business announcements in the downtown market in the next year. I think we're going to see employers continue to offer workplace amenities to try to entice their employees to come back to the office. One of these might be offering a hybrid workplace, giving them the opportunity to work 4 days at the office and 1 day at home, or 3 days at the office and 2 days at home. I think we're going to see the announcement of a Class A suburban office project. Once again, keep your eyes on South Minnesota Avenue. Also, keep your eyes on East 26th Street. With a 3% vacancy in that Class A space in our suburban market, the demand is definitely there to absorb that. I think we're going to see decisions by large office users. As we touched a few slides ago on shadow vacancy, I think we're going to see one of 3 things happen with these big corporate offices. I think 1, we're going to see parking lots start to fill up as employees are coming back to the office. I think 2, I think we might see some sales of some of these large office buildings. Or 3, we're going to see large amounts of sublease space hit the market. And lastly, I expect to see an announcement or 2 for a repurposed office building project in Sioux Falls, much like Graco's purchase of Wells Fargo's call center. So where does that put us on the real estate cycle? In 2020, we were at the beginning of the recovery cycle. And in 2021, with decreasing vacancy rates, high new construction, high absorption, and increasing employment growth, and also increasing rental rates, I have us at the beginning of the expansion cycle. And I see us there for the next 12 to 18 months. And with that, that concludes my presentation on the office market. And I'd like to invite Rob Kurtenbach up to talk about the retail market. Thank you.
All right, thanks, Alex. Well, my name is Rob Kurtenbach, and I'll be presenting on the retail sector for today's Market Outlook presentation. And as we all know, the year of 2020 had a bunch of uncertainty for many of us, and that was no different for our retail business owners as well. And we reported this last year, but we saw a massive increase in the online sales, but our overall bricks and mortar and overall retail market held up pretty well, all things considered. Let's take a look at how we did for 2021. And we're going to start real local here, and in particular, I'm going to focus for a little while at Empire Place. This is an area that was completely transformed over the last couple of years. In the last 12 to 18 months, they had some major announcements and openings of Chase Bank, Chick-fil-A, Crumble Cookie, Chipotle, just to name a few. And what I want to point out with those is all those four that I just announced, the major retailers for that area, are all national retailers setting up their first location here in Sioux Falls. That's a big deal for one area to attract that many national retailers on their first site. And what I also want us to remember is that this was the location of a very tired Sioux Falls Ford building just a few short years ago. So it's amazing to think back at how this place has been transformed over the last couple of years. And also thinking, as we're speaking of a couple years ago, on a prior market outlook, we talked about traffic counts, and traffic counts in the mall area had been decreasing the prior few years leading up to that. And we were kind of hard on them, kind of beating them up a little bit on what was going to happen in this mall area. And we're not going to dive into traffic counts today because a lot of the data is not really there yet because most of these businesses opened kind of in the later part of 21. But we're going to keep an eye on that. We'll report back on that next year, but it's probably safe to assume they're seeing some pretty good traffic counts in the mall area going forward. Well, also on this slide, we have Dave & Buster's. As we all know, 2019 they started construction, into 2020, the pandemic hit, everything gets put on pause. And a user like that with a pandemic was really affected, so they just completely press paused. But the good news is about a couple months ago, they started resuming construction, and they're looking to open up here in just a few short months. That's also another national retailer making its first location here in Sioux Falls. Locally, we had a couple other business owners that are locally owned that had some pretty big announcements as well, and I don't want to forget about them. Just to name a few of them, Roundhouse Brewery, it was a brand new concept that came to town and that was started by some local business owners. They not only took the risk to open the business and the restaurant right outside of a pandemic, but they bought the building that they're in because they're there to stay. They're investing in Sioux Falls. Spoken Sport is another retailer that's locally owned here. They opened their second Sioux Falls location right off of I-229 and Cliff Avenue. At the Attic, they opened a location on the west side, and then we also had Highball, which would be a team favorite of ours, a great cocktail bar downtown that you should definitely check out if you haven't already. But I just want to commend all those local business owners coming out of a pandemic. That's a bold move to take on some of that risk and open additional locations. So props to those guys for doing that, and also to the lenders in the room. Thank you for believing in the city of Sioux Falls and those retailers. Our retail market is sitting pretty good right now. Well, let's take a look at some areas to watch. I'm going to start in that northwest corner of the map, the top left corner there, northwest corner of Sioux Falls. This has kind of been an area that I think we've all been kind of waiting for it to take off, and it hasn't quite taken off. And we're all familiar with what's happening at Foundation Park that's going to completely change that area. And with that comes a ton of demand for housing in the northwest side of Sioux Falls. Look for this area to really start to take shape over the next couple of years, and watch for retailers to kind of fill the gaps between Jefferson High School all the way up north to I-90. 41st and Ellis, another area that has been changing. It's in process. There's a lot of retail centers that have opened up there. If you haven't been by the west side of Sioux Falls at 41st and Ellis in a while, you should drive by there. There's a lot of activity. And those retail centers are getting filled up. As they get filled up, we'll see additional retail centers happening at 41st and Ellis. Going south, we got the 85th Street and I-29 interchange. That's been in the works for a long time. It's getting closer to being a reality. That is an area that I do expect to be a very hot retail area once that is up and running. Braden talked about this a little bit earlier, but we'll kind of come southeast a little bit to South Veterans Parkway. Now, we're pretty early stages there, so it's a little hard to tell exactly where all the retail centers are going to be, but nonetheless, that's going to dramatically change that southern part of Sioux Falls. Heading north on Veterans Parkway, Dolly Farm is an area that's obviously quite established, but it continues to grow. There's not a lot of land left directly in that Dolly Farms area, so we expect that to kind of grow north. And lastly, certainly not least, Alex talked about this just a few minutes ago, downtown Sioux Falls is exploding, and it's really exciting to see some of those projects happening with Sharapa and the Steel District. We got some really cool projects happening in downtown Sioux Falls. And just to mention that these are all not necessarily retail-only sites, but I think it just shows us how robust the city of Sioux Falls is, and it's an exciting time for the city of Sioux Falls, but for the retailers as well. Let's take a look at some vacancy rates. We report on this almost every single year. We did not have any major changes from 20 to 21, but I think it's worth just talking this through. Our overall vacancy rate is about 12.5%, which came down from last year. So we're in a good spot with vacancy rates for these particular areas. If you remember from a couple years ago, we had some big box vacant buildings that that really changed the numbers that we had on here. I believe we had a 36% vacancy rate on East Sioux Falls with Kmart and Shopko. Well, clearly these have all been backfilled, and we've really stabilized our vacancy rates, and I expect that to continue into 22 as well. And also just a note on there, I do show the different lease rates in each of those areas. It's a pretty broad range, and we understand that, but it just kind of gives you an idea from Class A to Class C what kind of some price points might be for leasing. Let's look at some sales. 2020 was surprisingly a pretty good year. We had about $75 million in sales for 2020. If you look on the red line there on your graph, 2021 was a monster year, and so that we're up to $120 million in retail property sales for 2021. The big one to talk through on that is the Western Mall sold for $47 million, and so that certainly pushes that number up. Now we always kind of have this wrestling match of if we should include these outliers or not. I am including it, but I wanted to point that out, that it is included in there. Regardless, even if you take it out, we had a really strong year with retail property sales. Let's look at online. We talked about this last year, the online explosion of 2020. You can see it with the light blue color on your screen. It just shot up there, and just an incredible year for online retailers. But what I really want us to notice on here is this is a year-over-year growth chart that you're seeing. So we grew 14% in 2021, even after a monster year in 2020. So clearly the demand for online retail continues to grow. And I also want to point out, it's always interesting to look up these stats, but Amazon is still the king of retail. Jeff Bezos is still doing just fine, in case you were worried. They control about 42% of the overall retail market share. Another interesting one that I always like to look at is how much of online sales is comparative to all the overall retail market, and they're currently at about 19%. All right, let's look at some trends and predictions. Dynamic pricing is the first one I want to touch on. That's a really interesting one to watch. You may hear it called surge pricing. This is not necessarily a new trend, but it is one that I do think is going to become more and more common in the years ahead. What this is retailers removing the old paper pricing labels and replacing them with the digital electronic pricing labels. You've maybe seen it in a Kohl's or a Best Buy as they've tested this out in a few different markets. I think that's going to get to be more and more common. And what that does is it gives retailers the ability to adjust their pricing much more frequently. So for example, right before the Super Bowl, we all got to go get our big TV. Well, if they got two left, they can jack the price up because they know one of us is going to probably fall for it and pay for it because we need that TV. Same goes on the flip side. If a competitor has a big sale on some TVs, they can pull that pricing down to match their competitors so that they still attract you to come to their business to make that purchase. Regardless, I think dynamic pricing is something we're going to see more of. Think of it like you do for your airline carriers when you buy tickets online. Those prices change often by the month, by the week, by the day, by the hour. I think we're going to see that for our everyday goods and services in the near future. Continued labor shortages, we can all agree that's going to be a continued struggle. Retailers are no different. They got to figure out and continue to get more creative on how to do more with less. Online grocery sales, no surprise here. Pickup and delivery sales have skyrocketed, and we expect that to continue for the next couple years as well. Drive-through demand, retailers have to get more creative and more innovative on how they handle the demand for retail. They're getting creative in how they handle their ordering process, and also look for some retailers, if space allows, to go to a multi-lane drive-through versus a single-lane drive-through. Free shipping and fast delivery, we've touched on this in prior presentations, but that's really an expectation if you buy something online right now. We all want it fast and we want it free, and that'll continue as well. Increase in brick and mortar sales, this is an interesting one. I do think 22 will be a really strong year for bricks and mortar retailers. And part of that, I think, is going to be driven by the fact that we all have this desire to get out and socialize. And I think the retailers are going to reap the benefits from that. Much like maybe a few of you in the audience here today, you might be here for the happy hour, not the education hour. And locally, we touched on this at the beginning of the presentation, or the beginning of the retail presentation. We had several national brands coming to our market. Well, these national retailers have had great success, and we expect many of them, if they aren't already, they are looking to add additional locations in the city of Sioux Falls, and their success is going to attract other national retailers with similar concepts to come to the Sioux Falls market. So I think we're going to see some additional retailers come as well. I also think we're going to see at least one big box store announcement coming to Sioux Falls for 2022. Well, where are we at in the real estate cycle? In 2020, we were in expansion mode. 2021, no different. We're continuing to expand, and I think we're going to sit here for 22 as well. With that, I'm going to invite Rob Fagnan up to present on the industrial market.
Well, thanks, Rob. Now, the industrial market has never really been considered one of those darling asset classes like the pretty boys Alex and Rob get to present on. Braden and I get the kind of the humbug presentation. But I think that tide is starting to shift. And I could probably give an hour-long presentation on all the ins and outs that are taking place within industry right now. But unfortunately, Mr. Gusto over there, and I'm going to point directly at you, has a slide deck of about 97 slides. And when I challenged him to an arm wrestling match to see who could, have the most slides, you could probably guess who won on that. So actually, this thought just came to me while I'm standing up here, Nick. How is it that as the Fed continues to print so much money, that your slide deck just continues to lengthen? Something for you to think about. Anyways, I digress. So the industrial universe. Let's make sure this thing's working here. There we go. From China all the way down to Sioux Falls is made up of those properties that are used for manufacturing, warehousing, transportation, contractor shops, and data centers. It's what I like to refer to as the lifeblood that really drives the world economy. So that's where I'm going to start. I'm going to start from a macro level, bring it down to Sioux Falls, and make a few predictions of where I think we're headed throughout the rest of this year. So let's jump in. Now, I'm sure many of you are tired about hearing all about COVID. I know I am. But it's really important to highlight some of the major changes that we've seen in industry over these past years. And I'm going to start with one that Reggie talked about, and that's supply chain. It's been the buzzword that everybody is talking about. Now, pre-COVID, we had this robust supply chain where there was no shortage of inventory anywhere. However, when COVID hit, we saw massive disruption within the supply chain. Ports worldwide are being congested with ships, and I was able to experience that just this past year in August. My family and I went out to go visit family out in Seal Beach, California, and I was standing at the end of the pier, and I think I counted about 32 container ships that were all anchored down, waiting to get into the port of Long Beach. So you might be asking, why is there so much congestion? Well, number one, labor shortages. The hours of operation at these ports have been reduced significantly. And number two, we continue to see a severe shortage of truck drivers nationwide. And so with nobody to offload that product and stick it into a warehouse ending up in the consumer's hands, we have a supply chain disruption. So that's major change number one. Number two is reverse logistics, and I talked about this a couple years ago as an emerging trend, and it's simply the process of returning a product back to the retailer you purchased it from. Now, one of the things with the increased cost of transportation, among other things, retailers are starting to shift gears and do what I've coined a just keep it model. Now, I know this is really tough to see, but this is a real world example within my own household. My wife this past year purchased an outdoor patio set, and this is the receipt. She purchased an outdoor patio set. It showed up damaged. She called them up and said, hey, I need a return receipt for this because it's damaged. They said, you know what? Don't worry about it. Just keep it, and we'll send out a new one. Well, to make a long story short, after the fourth shipment, we finally received an undamaged product. And so what retailers are doing, and again, it's hard to see, but this is a $2,000 credit over here. So these retailers are realizing that the reverse logistics of that product is just too costly. And needless to say, we had some family and friends that benefited from this just keep it model. So, change number three, labor shortages. Rob and Reggie talked about this. We're seeing shortages in labor within industry in a whole new way, and particularly manufacturing. One of the things that manufacturers are doing to combat this is to implement automation and robotics within their manufacturing processes. A perfect example of this on a local level is DeGeese Manufacturing or Gage Brothers. If you ever get the opportunity to tour one of those facilities, it's fascinating the automation that they've implemented into their manufacturing processes. Now, lastly, I'll let Summer go ahead and get me to where I need to be. Lastly, just-in-time logistics. Now, this has everything to do with how inventory is managed. And so I'm sure many of you have heard of just-in-time logistics. What it is basically when companies have just enough inventory on hand to fulfill their purchase orders. Well, COVID affected that. It found a flaw in the system. And so what a lot of these companies are doing is they're switching to a just-in-case model. And this just-in-case model means that they're stockpiling inventory now. And so what we're seeing is a lot of buildings get either oversized or companies leasing additional space, also sending it out to third-party companies on a local level. That would be companies such as Nordica Warehousing, Windchill, and obviously Amazon. So with all these changes that are taking place, how is it affecting us on a local level? And I'm going to start off with our local industrial universe, the total square footage that makes up our market. Now, a year ago, I said that we would probably see about a 15 to 20% increase in the total number of square footage within our market. For once, I was actually right. 16.7%, a record within our market, from 25 million square feet in 2020 all the way up to about 29 million square feet in 2021. Now, to put this into perspective, our market has essentially been building industrial buildings over the last 60 years. That's what got us to that 25 million square foot number. In 1 year's time, we added 1/6 of the overall market. Pretty fascinating. So what was that related to? Well, it was within just a couple of these properties. We saw a 721% increase in new construction this past year. Again, that's the equivalent of 70 football fields under one roof, if you can imagine that. Now, the FedEx project was a prime example of this just-in-case model that I talked about a second ago. They had originally planned to build about a 150,000 square foot facility. It ended up being about a 337,000 square foot facility. They overbuilt because they were banking on the future growth of Sioux Falls. A few other projects, Lineage Logistics, many of you may know that company as Windchill. They just got bought out. They added a 130,000 square foot facility. We've all heard about Amazon's 3 million square foot facility. And Furniture Mart added 300,000 square feet to their building this year. So with all this new construction, it's no surprise that we're starting to see a tapering off of transactions in the market. We saw right about 44 total transactions that equated to about $50 million in total dollars sold this past year. Now, a couple examples of that. It's a pretty wide range of what we're seeing on a price per square foot basis. We saw as high as $118 a square foot, all the way down to $27 a square foot. And that has to do with newer construction versus older construction and the type of build-out that is in these buildings. But the biggest thing I want to highlight on this slide is that we're finally starting to see property sell for north of $100 a square foot. Traditionally, over the past year or so, there's maybe been one or two. We're starting to see a lot of sales up in that range. Okay, some additional statistics. Net absorption, through the roof. 4.5 million square feet in 2021. Traditionally, we only see about 500,000 square feet get absorbed in our market. So this is by far a record year for industry. Naturally, all that absorption of space provides very limited product in the market. And so vacancy dropped all the way down to a record low of 1.43%. So with all this absorption, as fast as we're building space and it's getting absorbed, and with the lack of available product that's sitting out in the market, it's no surprise that we're starting to see asking rental rates increase in our market. And so in Class A through Class C, we've seen about a 50-cent per square foot bump over the last year. Now that leads me into my predictions. As far as new construction, there's no way, and I can guarantee you, we are not going to see 4 million square feet get built this year. So new square footage is going to drop. However, the total dollars spent on new construction is going to go up. There's some spec projects that haven't been announced yet that will be announced fairly soon in our market, which is what we really need. On top of CJ Foods. That's a $500 million project, and that number will depend on whether or not they pull their building permit this year or next year. I said vacancy continues to drop off, but with some of those spec projects, I think we'll start to see it turn around and just ever so slightly increase. Lease rates and sale prices will continue to rise with the lack of available product out in the market, and then that inflationary cost of construction. And sales transactions. So Nick will touch on this in just a second, but primarily in industrial property, owners are holding their interest as a hedge against inflation. And so I think we'll continue to see sales transactions fall off within the industrial space, pushing people to new construction. Where are we at on the real estate cycle? Well, for years, we've kind of teeter-tottered back and forth between expansion and hyper supply. We couldn't really figure out where we wanted to go there. But for 2021, much like Jesus just kind of walking on water right across there, skipping recession, the recovery, we ended up right over on dry ground again, and we're right in the beginning stages of expansion. So I'm super excited. Again, I know it's not as exciting as retail and office and all the fancy stuff, but I'm super excited of where the industrial market is headed for our community, because it's really going to drive a lot of jobs and growth within our community. And so with that, I would like to bring up Nick Gustafson to present on the investment market.
Thanks, Rob. In this portion of our presentation, we focus strictly on investment properties. We're going to take a look at macro trends on the national level. We're going to drill down to what's happening on Sioux Falls trends, and then we're going to take a look at some specific transactions in terms of cap rates. And using all this input, we're going to make some really solid predictions about 2022. We're investors. Everyone up here on this stage is an investor, and we know our clients have a lot of options when it comes to making investments. Some of our clients like to invest in equities, bonds, cryptocurrencies, commodities, or even buying entire businesses. Well, these 2021 returns look really good. Why would we even consider buying a piece of real estate? Let's take a look. There are several advantages that real estate investors have when it comes to investing in a property. First up is yield or cash flow. If you buy a 24-unit apartment building, you collect rents, you pay all the bills. At the end of the month, you have some cash left over. That's yield. And we can measure this in cap rates, internal rates of return, financial rates of return, cash on cash. We got all the tools to measure that. Also, typically, when you buy a good property in a good market and hold it for a long period of time, the property appreciates. The property is worth significantly more at the end of your holding period than when you bought it. Now, we're going to talk about hedge against inflation, but typically appreciation is so important. But it's not enough just to enjoy appreciation as a real estate investor. There's also really important tax advantages that come with owning real estate. Now, our controller is out in the audience, and my CPA would gleefully confirm I am not a tax expert. However, there's two really important tax advantages that real estate have when it comes to ownership. A 1031 exchange. That's a tax-deferred exchange where after your long appreciation, your long hold, and you get some appreciation, an investor can sell the property and defer the tax event indefinitely into the future. That helps an investor compound their investment. Next, depreciation. The IRS allows investors to depreciate an asset, a real estate asset, every year. That shelters some of that yield or cash flow from taxes. Now, we're going to talk a lot about hedge against inflation. Typically, we wrap that up in appreciation, but these are inflationary times. Owning a real asset shelters you. It's a hedge against the destructive power of inflation. And lastly, diversification. Conceptually, you could panic buy and sell a share of Facebook 1,000 times in a day. You can't do that with real estate. With a piece of commercial real estate, it can take 3 or 4 months to sell. It's really hard to panic sell a piece of commercial real estate. Investing in real estate is risky. A lot of bad things can happen to you, right? A tornado can blow the roof off. The building can burn down, and you could have the worst tenant known to the history of commercial real estate investing in your building. It's possible. Let's take a look at some safe investments. Savings accounts, money markets, CDs, 10-year treasury. These yields do not look very exciting. In fact, they haven't been very exciting for at least a decade. Savers have really taken it on the chin here. And now, it's not only a low interest rate environment, now it's inflationary. So if you have money in these accounts, you're losing about 7% of your purchasing power over the last 7 months. Let's take this down to a concrete level. Let's pretend we're looking at an older retired couple that after 50 years of hard work, doing the right things, investing, manages to accumulate $2 million and they put it in a money market. In 2006, that was $90,000 a year. Conceptually, I think we all could say, well, yeah, I think you could live comfortably as a retired couple with no kids for $90,000 a year. Well, in 2022, the yield now today is $10,000. I don't know about your family, but it'd be tough to live comfortably with $10,000 a year. Let's talk about real estate in a global context. A recent study put the world's wealth at $656 trillion. It's a lot of money. What's this made of? Global GDP, bond market, equities, residential real estate, agricultural land, commercial real estate, and gold. Well, commercial real estate's only worth about 5% of the world's value. That doesn't sound like much, but when you think about it, that's about a third of the value of all the stocks in every exchange traded in the world. Then, when you take a look at residential real estate, agricultural land, and commercial real estate, that combined number is 49% of the world's value, of the world's wealth. That's amazing. Real estate belongs in every person's portfolio. This is a busy, busy slide, but let's break it down and focus on what's important. This is the concept of yield. That red arrow right there, that's the 10-year treasury. That's a safe investment. This is contrasted with all these other bars are the yields of industrial, apartments, office, retail investments, and this goes all the way back to 2000. Just looking at this, there's a healthy delta. There's a healthy return for people willing to take some risk in real estate over a 10-year treasury. Let's take a look at sales. This is U.S. investment real estate sales going all the way back to 2007. The green bars is dollars. You can clearly see the recession back in 2008 and 2009 and the buildup we've experienced, the pullback we saw in COVID. Well, the U.S. sold about $600 billion worth of investment real estate last year. That's pretty amazing. And when you run the numbers, that represents about 4 out of every 100 investors selling a piece of property. That's pretty incredible. Let's also talk about appreciation. Remember I said appreciation is one of the advantages? This graph shows U.S. commercial property growth going all the way back to 2001. You can see the ramp up before the recession, the pullback in the recession, and then things have looked pretty good over the last 10, 12 years. Last year, U.S. commercial property appreciated at 15%. That's pretty good. And that also, not only is that a good appreciation number, that's far outpacing the inflation rate of 7.5%. That's pretty good. It's been 2 years since we've gotten together in person. And back 2 years ago, standing on this stage, we thought there was going to be a peak in 2020. We thought prices were going to increase. We thought there'd be a lot of profit taking, a lot of 1031 exchanges. And we thought prices would go up and the risk would really ramp up. Well, what actually happened over the last 2 years is that trillions and trillions and trillions of dollars were pumped into our market nationally, globally, on purpose. You know, the Fed wanted there to be a lot of liquidity out there. And what happened is a lot of that capital went to commercial real estate to invest in. And what happened is prices went up and yields went down. Now, not all these asset classes were winners, right? Hotels had a pretty rough go of it for at least a year, right? Hotels, it was rough. With all this liquidity in all of our U.S. markets, things have gotten really competitive for investors. We're seeing things that we've never seen before. Just a couple of weeks ago, an investor from Miami, based in Miami, bought an apartment building that our firm had listed in rural Iowa. They had never looked in the Midwest before, and they certainly hadn't looked in rural Iowa before. That's amazing. What were they doing? They were searching for yield. And now, as we're meeting here, the Fed is poised to raise rates for the first time since 2018. That's what happened. Let's switch gears here. Now, we're going to talk about Sioux Falls, and we're going to talk about Sioux Falls multifamily. You've heard great presentations on retail, office, industrial. We're going to take a moment and kind of appreciate multifamily. This graph shows new multifamily unit construction going all the way back to 2011. And it's clear to see in 2021, Sioux Falls developers built almost 2,000 units. That's incredible. Let's drill down further. This next graph shows kind of a slightly different take. This goes all the way back to 2012 and breaks down duplexes, townhomes, single family, and multifamily. That's a pretty impressive record that we saw last year. Let's take a look at vacancy. This red bar on this graph is Sioux Falls multifamily vacancy, and it goes all the way back to 2007, and this is contrasted with the blue bar, which is the US multifamily vacancy rate. Wow. In the last year, Sioux Falls multifamily vacancy went from 6% to 2.88%. That's incredible. That means there's almost no apartment units available. So what this means is you should be able to say, well, we can make a really confident prediction that instead of building 2,000 units this year in 2022, there should be at least 3,000, maybe 4,000 units built. What's the only thing that's going to hold that back? Construction prices. We'll have to wait and see on that. Let's take a look at rents. Over a short period of time, this graph shows conventional multifamily average unit rental growth, and it starts in mid-2018. You can see a nice, healthy appreciation in rents, and then in COVID, there was a sharp pullback. Landlords were nervous, right? They were willing to accept less rent to fill their units, and when it became clear that Sioux Falls wasn't going to be shut down by COVID, and vacancy rates plummeted, look at that intense rental growth that we've seen in the last couple of years. Let's take a look at sales. This goes all the way back to 2007. The bar shows sales in dollars in Sioux Falls multifamily transactions. You can see the dip in the recession, and you can see the big ramp up. Now keep in mind the number at the very top of the bar is transactions, these 4 units and higher, so these are 4plexes and higher. And an interesting trend that we've seen over the last 3 years is the price per unit ramping up aggressively. Back in 2019, $72,000 a unit was the average of done deals. 2022, $94,000 a unit. And last year, $110,000 per unit. That's incredible, and it was a record year. We're going to switch gears and look at specific cap rates on deals. We're going to start with multifamily, and we're going to go through a couple of asset classes. First up, East Point Apartments, $4.4 million. This was an early 90s development, a 6% cap rate. Whisper Ridge Apartments, almost $32 million transaction. This was built just 2 years ago, 5% cap rate. Garden Villas, $9.5 million. Built in 2016, 5% cap rate. Tally Ho Apartments, this is kind of your classic value add transaction. This is right off East 10th Street in 229. Almost 40% of all of these units were vacant at acquisition. Watch this new owner invest in all these vacant units and realize a really healthy profit. Creekstone Apartments, this was built in the late 80s. This is a big transaction. 220 units, $23 million, 5.66% cap rate. Gateway Apartments, $4.2 million, late 90s, 6.25% cap. West Point Apartments, another big transaction, $25 million, under 5% cap rate, 4.8. Switching gears to office. This office building in southern Sioux Falls is leased by Avera, $6.3 million, just under $300 a square foot, 5.25% cap rate. Minnesota Avenue building, this is just off 57th in Minnesota, $1.7 million, 7.5% cap rate. Nordica building, switching gears to industrial, $9 million, 6.25%, but look at that price per square foot, $42 a square foot. That looks like a pretty good buy. Ferguson building, this is right off of 14th and Cliff, $2.5 million, 7.5% cap rate. Everyone saw this in the papers. This is the Western Mall, $47 million transaction. Guys, there's one vacancy in this building right now, and this was a 7.3% cap rate. Small strip mall, just north of East Side Walmart, sold for $1.2 million, just under a 10% cap rate. Come and Go, East 26th Street Sycamore, 8% cap rate. I actually want to show you more cap rate slides, but my partners won't let me. So if you need additional information, come reach out, and I'll be happy to help you out. Okay? Let's kind of put an end cap here to this cap rate discussion. Multifamily, 4.5% to 6.5% range that we saw in last year's transactions. That really low cap rates, those 4.5%, we saw those in really large, really new, full apartment building transactions. Okay? The 6.5 are smaller, slightly older properties. Okay? And that's kind of the case for all these asset classes. My bold prediction for this year is even though interest rates are rising, cap rates won't change that much. We'll get into that in a moment. So my predictions, guys, midterms are right around the corner. I don't think we're going to see much in the terms of changes to our tax code. That's my prediction. I could be wrong. I just don't think taxes are going to change that much. What that means is if you own an investment property or have clients who do, and they want to make some long-term decisions in the near future, this is the year to do it because you know what your tax bill is going to be. Interest rates will rise. That's not really that genius of a prediction. We know it's going to happen, right? But what will happen that might be counterintuitive is that cap rates aren't going to change. They're going to remain lower than they have been historically because we know, just with our own clients, there is so many investors waiting for the right property to purchase. There's so much capital on the sidelines right now. Deep-pocketed investors will be willing to invest more equity into their transactions to compensate for the rising cost of capital. Cap rates are not going to go up anytime soon. 3, it's a really volatile time. There's some really sad headlines that we're seeing from around the world, and frankly, even the Canadians are rioting. So what we think is going to happen is investment real estate will continue to be a really great asset class to invest capital into. Finally, we're going to take a look at the multifamily real estate cycle. Based on all the trends that we just covered, we're firmly in an expansion phase. With that, I'd like to bring up Reggie Kuipers to conclude our presentation. Thank you.
Thanks, Dick. As you are well aware, we want to, again, thank you for being here. But as you're aware, we like to leave our guests with some swag. We've done coffee mugs and water bottles and phone chargers and all kinds of things. But this year, we're in the middle of building a new office building, and we love aerials. We're looking at maps all day long. And several of the brokers said, you know what, we'd like to have a cool map in our office. And so we thought maybe you would too. And so there's a QR code up here. You can also reach out to Summer Hoffman. Her email address is up there, or any of us. We would love to hand deliver one of these to you. And we are going to start happy hour very, very shortly, but we do have a quick video, a little tribute video that we want to play first. So see you in a few minutes. And after this, please join us.
No, Michael. We met right after they moved to Sioux Falls. I had invited Sarah Larson from Davenport Evans out to lunch. I was working at Western Bank in the trust department, and Sarah was gracious enough to agree to meet me. She brought Jean with her to lunch. Jean was brand new to Sioux Falls. They had just moved here from Dallas, although Jean was originally from Yankton. And we just had so much in common. She had just had a baby, I had just had a baby, and so we just kind of stayed in touch. And then shortly thereafter, I left Western Bank. Michael started his own business, and so we just hit it off from day one. We both started out together. I've had the opportunity to work with them all on a very frequent basis, and I think he has set a great example for the people he has chosen to follow and work with him. I think that team is also very dedicated to making Sioux Falls a better place.
I believe that Michael and Doug and Andy have set a high bar for the team at Bender for doing things right and for doing the right things. I've known Michael since he moved to Sioux Falls in 1992 and have enjoyed working alongside him both in business and all throughout the community in so many different ways. Michael and I have had the opportunity to serve on a number of boards together and in leadership roles, including the Greater Sioux Falls Chamber and also the Avera McKinnon Board. So I think the team at Bender has done a really nice job of enhancing the professionalism of the commercial real estate brokerage service industry here in Sioux Falls. They provide a great first impression of Sioux Falls for any company that might want to consider moving here.
Doug he's drilled into our heads that we need to become trusted advisors. We are not salespeople. We are not selling anything. We are only selling information. And we need to become a trusted advisor and a member of everybody's internal team when they make decisions as it pertains to commercial real estate. He's always had that education mindset, and he's always willing to spend time. And that's a unique thing about Doug. It's very difficult as a leader, to take time out of your busy schedule and to help others along the way. And he's had a dramatic impact on me and the others in the office about doing that and lifting us up. Andy is kind of like our big sister. She's a lot of fun, and she's kind of the spunky big sister in our group, and I don't know what we do without her. And to some of us, Michael's almost become like a second father. He's had this just gentle leadership style, and really, really thankful that we have all three of them to build this foundation for the last 25 years to our family members, to our wives, our spouses, our kids. Thank you for letting us do what we do. I know this takes a lot of time, and I know that we have some crazy hours sometimes, but I just want to say thank you to our families.
Well, I've known them on a professional and a personal matter for a couple of decades, and very good friends with all of them. Spent a lot of time with Michael, both personally and lots of projects that are going on in Sioux Falls, and we've had a number of transactions and development activities that we've been able to work on together. Michael and I served on the Avera McKinnon Board of Trustees together. And for 2 years, Michael was the chair ahead of me. And there was one constant legal lawyer attorney joke after the other. And I sat in silence for 2 years as I took the brunt of those. So when he termed off of the board, the tradition is that you give them a print that is picked out at one of the local art studios. We knew what Michael's print was. I superimposed over it. This is going back to his Texas days. A cowboy sitting on a horse, his face superimposed, got a great big hat on, and next to him we have a picture of a cow with a circle around it and a line through it, and the caption was, "Big hat, no cattle." Michael, I gotta tell you, don't hold it against me, but you got a big hat and lots of cattle.
So I think Michael and I met shortly after he started his firm. So a relationship probably goes back, at least 25 years or longer. So we probably worked together first. We have a mutual connection with the Avera group. So I think that's how we first got to know each other and started working together. And then Michael and the Bender team has represented us on some of our own property, on some of our own real estate. But we've worked together, we served together on several community boards and initiatives within the Sioux Falls community. When I think of Michael and the Bender team, Andy and Doug and the rest of the group, I really look at them as really demonstrating servant leadership, and they take it upon themselves to step up and lead into initiatives within the community and set a great example for us as other leaders in the community about how it's our responsibility to, with our time, talent, and treasure, to get involved, to help lead lead organizations, serve on community boards, and just make Sioux Falls a better place to live, work, and raise our families.
To Michael, Doug, and Andy, thank you for the foundation that you've built for us. Michael and Andy, I know, had their best years ever last year. Michael continues to tell us that he's going to keep showing up and kicking our butts on the brokerage team. And so we look forward to continuing to work with you guys and want to thank you for everything that you've done and the foundation that you've built and the impact that you've had on us individually, the community, and our team. So thank you for everything.
Well, I am so thankful for Michael, Jean, and the entire team at Bender Commercial. They've been just unreplaceable to me and to my office and everyone in Sioux Falls. Congratulations on all of your past successes and to 25 more years to come.
I want to personally congratulate Michael and Andy and Doug and Reggie and the whole team. What you've brought to Sioux Falls and what you continue to bring year after year is, I think, crucial to understanding where Sioux Falls is headed, and you've been a big part of its success, and I would expect that to continue for the next couple of generations. Thank you.
Congratulations on a wonderful 25 years. You've made a big difference in our community, and I wish you all the very best in the next 25 years to come.
I just want to congratulate the Bender team on 25 years of success and wish you continued success in the future. You've tremendously impacted our community, and I can't wait to see what the future holds for you and the great organization that you have built.